Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. I look at the week's financial news that can be a bit confusing, misleading, and take you off course, and help to make it actionable, understandable, and clear. What a week, what a show. Sadly, I'm in studio by myself. One of our frequent guests, Mr. Bobby Hunt, is out and about. He's got his own life. He can't always be here in studio. But we've got a wonderful slate of news to go through with you, the listener. We're going to be looking at a Wall Street Journal article sent in by a friend of the show, actually. They know who they are. They've actually been on the show, if you really want to look through past podcast guests. Great article sent in here on Citadel's Ken Griffin, how he's remade the hedge fund industry with himself on top. Whoa, there's a lot to parse through there on what winning actually looks like in investing. Do you want to win in investing? Stay tuned to the rest of the podcast, because it ain't how the article describes it. And then, you guys keep asking, and I finally agreed. We're going to be talking about Madam Vice President Kamala Harris's most recent tax plan. I actually have been getting questions and comments about it, so I want to at least dice through some of it so that you can understand what you need to worry about and what you don't need to worry about. And then I end with kind of a nice cherry on top for ways that we're already getting hosed that you can change today. And then at the very end, another friend of the show sent in a great new exchange-traded fund that I want to talk about. I'll then explain a personal story, so kind of a Robert's Corner about how I have been sucked in by these sorts of strategies before. So it's the deadlift ETF. Dun, dun, dun. You're going to want to listen to the end on that one. So at the top, this is an article by Peter Rudiger. This is headlined, Citadel's Ken Griffin has remade the hedge fund industry with himself on top. Let's start definitionally. What's a hedge fund? It's a pool of money. We know what pools of money are, just a bunch of money, put it together with a lot of different investors that seeks to beat the market. Now, of course, for my hedge fund listeners, you might say, aha, but the word hedge, why do we put the word hedge in there? Fair enough. They put the word hedge in there because some hedge funds try to be what's called market neutral, meaning irrespective of the S&P 500, stock markets moves up and down, they want to try to churn out returns year after year. Now, what happens in practice, listeners? The word hedge might as well be taken away, just could be all called fund, and I'd take away the word hedge, put high fee fund. Because when you dig into it, typically these funds have very high management fees at maybe 2% a year, and then performance fees, meaning if they earn over a certain hurdle rate, 20% or so of that profit share goes back to the fund company. So you can make a great deal of money owning a hedge fund the larger it gets. So enter scene one, Mr. Ken Griffin. The article begins. He's arguably at the top of the hedge fund game. He has a $63 billion with a B hedge fund firm, Citadel. And when you walk in to his Miami offices, it says the number one most profitable hedge fund manager of all time. That's on the elevator doors at the Miami headquarters. Now, for the uneducated investor, they might look at that and say, oh, incredible. There must be a money printing press in here. How do they do it? For the Robert Hunt Financial listener, we know what makes for great investing, don't we? We keep the cost low, we keep investing simple, deeper time, horizon long. I didn't have Bob to sing it. It's not the same without him. Homeschool your kids, guys. So keeping those three things in mind, is that what Citadel's doing? It's not, but listen, they don't seem to mind. Citadel they had a 1 year record haul of $16 billion in 2022. So that's assets they gained. He said, this is Griffin, we made more money than any firm has ever made in the history of capital markets. Now think about this, listener. Does that matter for you? Does that matter for me? Let's say we were investors in Citadel. How would we have done in 2023? Well, the article explains. Last year, the firm's flagship fund was up 15.3%. That outpaced the 7.4% gain in a broad hedge fund industry index. Gather the children around for this one. They're going to need to know this for decades to come. You realize they're bragging right here, don't you? They're saying we outpaced the hedge fund industry, which earned 7.4% in 2023, because we earned, Citadel, 15.3%. Now, what is a good listener of the Robert Hunt Financial Market Update doing right now? They're thinking to themselves, what about the index? What we can own for free? Well, how did that do in that time period? Now, that would be a wise question. Well, what do you think it did? About 23% or so. Now, I'm looking up the official number right here so that we get it just right for you. But on my previous, I did just a quick search, and it was 23%. So, 26% in 2023. It depends on the index. So let's take the Vanguard Total Stock Market Index, VTI, 26%. So you realize, guys, we could have blindly, boringly, our detractors would say lazily, put all the money in an index fund and absolutely trounced the most profitable hedge fund manager of all time. Let that sink in. Griffin, the gentleman that owns it, 55 years old, is known inside Citadel as an intense, demanding boss whose blue-eyed stare is a source of discomfort for employees. He's obsessed with guarding against complacency. Is he? Is he obsessed with guarding against complacency? I'd say pretty complacent at 15.3 compared to my 26%. I didn't have to look him in the eyes. Well, blue eyes, as they used to call Stonewall. I didn't have to get scared by him. I just got it by hitting the index. So he's got all this pop quizzes he does. He's super intense. He's doing all this stuff. He's got teams. This article goes into great detail about all these various teams of stock pickers he has distributed all throughout the firm. And it's uber competitive. And who's going to do it? And how'd they do? And remember that hedge fund line that the hedge fund industry will tell you? Or, no, we zig when the market zags. Well, 2008, 2009, it says its funds recorded losses of 55%, nearly torpedoing the firm. It took until 2012 to make the losses back. So much for the word hedge and the word hedge fund. So I say this not to pick on him. He is clearly successful. I think net worth, it says in this article, I forget, but it's like 30 billion or 40 billion. It's big. And he attended Harvard, which goes to show that Texas A&M is not for everybody. I'll tell anybody who'll listen, it's not for everybody. Not everybody likes swaying. I get it. So he went to Harvard, avoided the swaying. But if this is the best, if this is the greatest, if this is the fund we're supposed to look to as the fund of funds, but it can't beat our fuddy-duddy index, what are we doing, guys? What are people doing? And oh, by the way, there in this article, it says how great this 15.3% return was because in the flagship fund, it trumped Millennium, 0.72, and other competitors. So apparently, there are all these other highfalutin competitors that can't do it. They can't do it. Check this out. Fund expenses at firms like Citadel can amount to more than 7% of assets in a given year, according to Barclays. Ay. I get lightheaded thinking about those fees. But he's doing cool things. I mean, listen to the Robert Hunt Financial firm. We don't have these outings. Check out this outing. He took his top performers. This past February, the article explains, Griffin flew to Finland for the annual outing of Citadel's commodities team on top of a frozen lake. He strapped into the cockpit of a McLaren sports car to race against some of Citadel's biggest moneymakers. The Citadel team also faced off over hands of euchre, a Midwestern card game. Okay, so the index fund boys aren't taking you to Finland to race McLarens across ice, but they are dominating on the returns front. So choose this day where you will invest. As for me and my house, we're keeping our costs low. Our investing simple and our time horizon long, but you already knew that. Up next, this is, again, the crowd is asking for it, and therefore I am delivering. No, I'm not announcing my pick for president this election cycle. I've had folks try to make this a partisan podcast. I think we may actually sway the election if I were to announce it this early. So stay tuned for future episodes. Maybe we announce my pick in the future. But right now, Kamala Harris, she announces a $5 trillion tax plan, kind of through messengers. Basically, Biden announced it. But I want to focus in on what I'm hearing feedback from clients. So she proposed increasing taxes quite a bit for a number of folks. She has various brackets. One of the things she's proposing for those who make over $1 million or more is changing the preferred rates on investment income from 20% or preferred dividends or capital gains to top rate. So if you make over $1 million, you're going to be paying top rate. The actual tax brackets will go up, not a ton, from like the top rate being 37 to like 39, but the Medicare tax would go up. So you're getting close to 45% all in if you make more than $400,000 when you add up some of these new taxes or increased taxes. Now, the real kicker that's getting everybody up in arms is the unrealized capital gains tax, otherwise known as a wealth tax. So what has been explained thus far is that people with more than $100 million in net worth would have to pay at least 25%. And this is an article, forgive me, from the New York Times, because we read it all here at the Market Update. 25% on a combination of their income and their unrealized capital gains. That's the value of appreciation in stocks, bonds, real estate, and other assets they own but haven't sold. They're somehow calling this the billionaire's minimum tax, but I guess it's only for folks with $100 million. But that's what's got people up in arms, because it's never been done before. Is it constitutional? We don't know. But also of course, 1913, when the U.S. income tax was instituted, it was assured to the people this would only affect a very, very, very small percentage of the populace, less than 1%. As you and I know, everybody pays income taxes now. So part of the concern is that, well, if this wealth tax is introduced, not only will there'll be incredible complexity and difficulty for the taxpayer, but for those of you who think this is not coming for me, history would indicate that it certainly is coming for you. This is just the beta test. Now, I don't know whether something like this will make it through. I don't know if she will win and be able to propose this. I don't know even if she wins. The Democratic Party has proposed this in previous times, even when they controlled the House and the Senate, and they didn't institute it. So oftentimes the suits come in and tell people how it's really done, sometimes all to the good, in my opinion, in this instance. But as an investor, I am suspicious of making any major moves on any news like this. So I understand why it is tempting to start to worry and think, I need to get my money out of publicly traded assets that are where it's easy to determine their value. Because just to explain how this would work, let's pretend like the unrealized tax was for everybody. So right now it's for those with over $100 million in net worth. But let's say over time it was everybody. Hey, no matter what, 10% of your net worth you have to give to the government every year. The toughie about that is you don't have cash. So this is why people are up in arms, especially in venture capital. You don't have the actual cash. You have to borrow the money. You have to sell the asset to pay it. I mean, this is why I think it's a really bad idea, like not a good idea at all. But you know what it reminded me of? And in fact, I saw this on Twitter. Do you know what else is an unrealized gains tax that we should be more up in arms about that's happening right now under our noses? Assets under management fees. That's right. So if you are just angry when you see Ms. Harris's proposal, how could they? How dare they value my assets and then tell me what they're worth and then it forced me to sell them down to, for as many people I hear that from, they're in traditional financial advisory relationships and are paying a percentage of their assets every year. Oh, by the way, on unrealized gains. Now, I must give credit where credit's due. This is from Mr. Bill Winterberg, CFP, on Twitter, where he says AUM fees are assessed on unrealized gains too, and he has a picture of a confused man. So I think this is just a grand reminder to say, as mad as you might be at what you would describe as Marxism, I would too. Let's control what we can here for a moment and say, Well, hold up. Am I paying a percentage already on unrealized gains? Yes, you are. Yes, you are. No, by the way, how do they get paid? How does the advisor who charges AUM fees get paid? They got to sell stuff. They don't get paid in stock. They get paid in cash. So find yourself an hourly advisor. Don't, if you're going to wring your hands about Ms. Harris's proposal, I think let's go back to that first article I read on Citadel. That's wild. 7%. Goodness gracious. It's just as wild to me to pay AUM fees. You don't have to do it. Not today. And then in closing, a friend of the show sent this in. A deadlift CEO with only companies with CEOs that lift weights or do fight sports, not just cardio. It outperformed the S&P 500 by, get this, 140% or 2.4 times over the last 4 years. So I've got a chart here. It shows the deadlift ETF, the Vanguard 500, and how much better the deadlift ETF did. Lifting weights equals money is the kind of the tagline. Wow. Who wants to go into the deadlift ETF? I do get it. Hey, that's good. These CEOs are tough. Beware, investor. We might chuckle at this. This is clearly kind of a ha-ha thing. But I have been, throughout my life, sucked into things like this because it is so tempting to extrapolate past returns to the future. I've heard eloquent pitches that made all the sense. It wasn't deadlift. It was we scrubbed and scrubbed and scrubbed these publicly traded companies for earnings, and we got the real earnings, not this EBITDA business, and we used cash flows, and we used all these filters, and it has outperformed the last 20 years. How compelling is that? And all you got to do is invest with us, and then you'll outperform over the next 20 years. It just never works that way. If it was that easy, anybody would do it. So whenever you see something like this where it says, hey, we've sliced and diced, and we've got the deadlift CEO or the cold plunge CEO or the eats carrots at night CEO or the, you name it. Stick with what results in better returns over a long time, which is keeping those costs low, that investing simple, and that time horizon long. We look forward to having you next week. Until then.